Hello friends, welcome to this video on Gap Advisors channel. Myself CM Manish C. Iyer. In this video we will discuss on the amendments to recognition and derecognition of financial instruments proposed by the exposure draft issued by the IASB, which has the potential to significantly change current accounting practices and the requirement to prepare bank reconciliation statement. Before we discuss the amendments proposed, we need to understand why the IASB is proposing the amendment. IFRS Interpretations Committee received a request about the application of IFRS 9 in relation to the recognition of cash received by an entity via electronic transfer as settlement of a financial asset. The agenda decision said that in accordance with IFRS 9, the cash flows to the receivable expires only when cash is received, that is when the amount gets credited in bank account. The agenda decision was an eye-opener on the derecognition of financial asset. Normally, companies credit the receivable when check is received. The difference between the bank balance in books and bank statements due to check received but not deposited or cleared were recorded in bank reconciliation statement. The agenda decision meant to change this practice. Though the agenda decision expounded the application of derecognition requirements of IFRS 9, comments were received that this has the potential to change long-standing practices. Thus, entities were not applying the derecognition requirements in the manner required. Therefore, IASB felt a need to A. Clarify the date on which financial instruments must be recognized and derecognized, and B. Permit entities to derecognize financial liabilities that are settled with cash using an electronic system before the date specified above. That is in A. NFRA order in the matter of Coffee Day Global Limited highlights the fraud risks of current practice of derecognizing before cash is received in the bank account. There is a separate video on this. Viewers may watch that video to understand the fraudulent practices and how the same can be mitigated by this amendment. The exposure draft proposes to insert para B312A to mandate recognition and derecognition at settlement date, except in case of regular way purchase or sale and in case of derecognition of financial liabilities when they are settled using an electronic system. We will understand in next slide the dates specified in Ind AS 109 or IFRS 9 for recognition of financial instruments. The exposure draft also proposes to insert para B338 and B339 relating to derecognition of financial liabilities settled with cash using an electronic payment system. The conditions specified in para B338 and para B339 are, in my view, self-explanatory and therefore I am not discussing them here. If you need any clarifications in this regard, please post your comments and I will respond to the extent possible. The outcome of the amendments will be that companies will not be able to derecognize financial assets and financial liabilities if cash is not received or paid. Receipt or a deposit of checks cannot be considered as cash received, and issuance of checks cannot be considered as cash paid. Accordingly, the entries in bank reconciliation statement for checks received but not cleared, or checks issued but not cleared, will disappear once the amendments are finalized. Also, there would not be balances as checks in hand or book overdraft unless their difference is on account of dispute with bank. Therefore, the amendment looks very small but has significant implications for accounting systems. Hence, it is important that all companies following Ind AS and their auditors be aware of this amendment and keep close watch on the developments. To understand the amendments proposed, understanding of different dates specified in IFRS 9 or Ind AS 109 is important. Therefore, the discussion on this slide will be a bit longer. Ind AS 109 or IFRS 9 talk of three dates: commitment date, trade date and settlement date. Para 311 requires financial assets and financial liabilities to be recognized when the entity becomes a party to the contract. Para B312 provides guidance on application of Para 311 with examples of different types of financial assets and financial liabilities such as unconditional receivables and payables, firm commitments to buy or sell a non-financial item, forward contract, option contract and planned future transactions. In case of firm commitment to buy or sell a non-financial item and forward contract, para B312 requires a recognition on commitment date. However, a standard does not explain or define commitment date. In normal parlance, commitment date is a date when a party commits itself to the contract. Therefore, reading para 311 and B312, we understand that financial assets and financial liabilities are to be recognized on commitment date. However, para 312 states that a regular way purchase or sale shall be recognized and de-recognized using either trade date or settlement date accounting. Therefore, the notion of trade date and settlement date arises from the requirement to differentiate a regular way purchase or sale from other financial assets and financial liabilities. Other financial assets and financial liabilities are to be recognized on commitment date, which may be either trade date or settlement date. Let us understand trade date and settlement date. Para B315 explains trade date as a date an entity commits itself to purchase or sell an asset. Thus, reading this, one would conclude that a trade date is commitment date, and therefore all financial assets and financial liabilities other than a regular way purchase or sale are also recognized on trade date. However, para B315 also says the title does not pass on trade date. Title passes on settlement date. Para B316 explains settlement date as the date an asset is delivered to or by an entity. Now, reading this, one is confused whether commitment date is trade date or settlement date. A commitment has no meaning if no title passes and no asset is delivered to or by an entity on the commitment date. Therefore, one may conclude that commitment date is the settlement date when title passes, because a recognition of financial asset or financial liability other than a regular way purchase or sale happens when title passes. This is the date when an entity becomes party to the contractual provisions of the instrument. This is also the conclusion of IASB as it states in para BC 10 of the exposure draft that except for a regular way purchase or sale of financial assets, IFRS 9 requires an entity to apply settlement date accounting when recognizing and derecognizing financial assets. Therefore, the insertion of para B312A mandating financial assets and financial liabilities to be derecognized on settlement date is only clarificatory as the standard requires interpretation to understand that commitment date is the settlement date and not trade date. I have seen listed companies specifying in the accounting policies that financial assets and financial liabilities other than a regular way purchase or sale are being recognized on trade date. However, I have not seen the same in case of derecognition. Therefore, companies are not very clear that commitment date is the settlement date. Such companies must keep a close watch on the exposure draft and further developments so as to be ready for any change required before the effective date. The issue was with derecognition of financial assets and financial liabilities. It is not clear why the IASB is then proposing changes to the date of recognition. Proposed para B312A will only increase the confusion because para B312 uses commitment date and not settlement date. Clarifying that commitment date is settlement date could have other consequences. Para B311 says that a transferred financial asset can be recognized by the transferee only if derecognized by the transferor. Derecognition happens on settlement date. Thus, it is clear that transferred financial assets can be recognized only on settlement date. However, originated financial assets and financial liabilities are recognized on commitment date. To remove the confusion, we recommend that IASB may specify in proposed para B312A as shown on your screens. Thank you for watching this video. Do post your views on the amendments as comments to this video. Register on gapadvisors.com and start Task Solo, the learning or the earning game on Ind AS and Indian GAAP. Top 5 Task Solo rankers will get cash award of Rupee 5000 on 1st June 2023. So log in now and start Task Solo. Secure a place among top 5 on the morning of 1st June 2023. Thank you.